This is Glenn Robinson, President of the World Affairs Council of the Monterey Bay Area. I would like to welcome you to our newest edition of Quick Takes on International Affairs. Please enjoy this talk and do consider joining the World Affairs Council.
Hello, everybody. Today we're going to talk about China's economy, and in particular, how sustainable is its current model for continued growth. So time is limited. Let's get started. I'll put my cards on the table. China's economy should be able to grow at a reasonably high rate for some time to come. The main constraints on China's economy are not economic. They are, in fact, political. Specifically, the Chinese Communist Party's reluctance to liberate market forces and invigorate the private sector serves as a drag on economic growth. Issues around liberating market forces and invigorating the private sector are political in nature. So let's dig into this in more detail, why I believe this. In fact, China's economy has been growing more slowly over the last several years. As you can see by this graph, it achieved high rates in the 90s and the early 2000s, and since 2005 has been showing a consistent decline in growth rates. Now the question is this inevitable? There's a group of policymakers and economists who simply say, well, this is inevitable. As China got larger, the base got larger, this had to happen. There are others, including myself, who say, no, it didn't. And in fact, there are reasons why China continued to grow at a fairly fast pace. And we'll now get into the reasons I believe that. This graph shows one reason, prima facie, but still I think quite powerful, that I think China can continue to grow at a fast pace if it does certain things. And we'll talk about those things in a minute. But here is a graph that compares China, Korea, and Singapore. And on the x-axis is what percent of US per capita GDP is each country producing over time, okay? And then on the y-axis is per capita GDP growth rate, all right? So on the x-axis is percent US per capita GDP, on the y-axis is per capita growth rate. Now you see in the case of China, it has gotten to 6% GDP growth rate at a point where its per capita GDP is about 25% of US per capita GDP. Korea, on the other hand, when its growth rate declined to 6% and started to moderate, was at 50% of US per capita GDP already. And in the case of Singapore, when its GDP growth rate got to about 6% and then started to trend downward to where it is today, it was over 100% of US per capita GDP. So granted, this is prima facie evidence. There are differences between China and Korea and Singapore, obviously, but culturally there are some strong similarities. And so this would lead one to believe that it is too early in China's development process for it to be declining, its GDP growth to be declining 6, 5, 4%. Now, of course, it's more likely that these numbers, China's growth rates, are inflated more likely than Korea's and Singapore's, given some of the sketchy numbers we get out of China. These growth rates are likely to be slightly inflated, if anything. So again, this is very strong prima facie evidence, I believe, that it's too early in China's growth process to be getting down to 6, 5% growth. So what's China's problem? Why is it, I think, that China has potential to grow at a faster rate for some time to come? In order to talk about China's problem, I want to review a couple of basic macroeconomic concepts, those being total factor productivity and GDP. Let's talk about total factor productivity first, okay? Total factor productivity comes into what economists call economic growth accounting. What accounts for growth year on year? Where does growth come from? And total factor productivity is basically a residual category. According to the World Bank, In the standard growth accounting framework, growth in output per worker can be allocated into contributions from changes in physical capital, employment, human capital, in other words, the education and skills of the labor force, and a residual. And the residual is called total factor productivity, or TFP. TFP measures gains in economic efficiency, the quantity of output produced with a given quantity of inputs, including those driven by technological progress. A well-known economics textbook, co-written by Nobel Prize winner Paul Krugman, defines it as this way. Total factor productivity is the amount of output that can be produced with a given amount of factor inputs. So when total factor productivity increases, the economy can produce more output with the same quantity of physical capital, human capital, and labor. Most estimates find that increases in total factor productivity are central to a country's economic growth. In other words, total factor productivity asks the age-old question, is the economy working hard or working smart? So far, every developed economy got that way by working smart, okay? So this is a very important historical perspective. So how does GDP get made, and what is total factor productivity's role in it? Well, here's a simple chart that shows how you start off with land, labor, and capital. And that labor and capital goes into what I call a black box. And that black box consists of innovation, technology, governance at the macro and micro levels, at the firm level, as well as the macroeconomy level, human capital, how well educated, competent is your workforce. And so your inputs go into that black box and spits out GDP, okay? Now, in the old economy, which I believe existed, primarily up until the Industrial Revolution, land, labor, and capital were critical for the most important things to generate GDP, which is why you had wars over land, labor, and capital. However, in the new economy, it is clear that innovation, governance, and human capital are just as important, if not more important now, in the production of GDP and growing GDP than land, labor, and capital traditionally were. If you don't believe it, just compare Russia and Singapore. Russia is very, very wealthy in the traditional inputs of land, labor, and capital, whereas Singapore is not. However, Singapore does much better when it comes to GDP and GDP growth and sustainability because of the innovation, governance, and the human capital of Singapore. So this is one way of thinking about the old economy versus what I call the new economy. Now, in fact, this is extremely good news for China because China does not have a comparative advantage in land, labor, and capital, but it can achieve a sustainable comparative advantage in this area, innovation, governance, and human capital, if it does the right things. So in fact, as I said, this is really good news for China that they are developing into the new economy. Economists call, when you rely on the inputs increasing into the black box for your GDP growth, economists call that extensive growth. Whereas if your economy is driven primarily by what's going on here in the black box, innovation, governance, et cetera, economists call this intensive growth. And this is where total factor productivity leads the way. Now, let's look at China's total factor productivity in the reform era. This is adapted again from the World Bank data. On the x-axis, you have contributions to the average annual change in real output per worker percentage. Those contributions being divided into human capital per worker, physical capital per worker, and the residual total factor productivity, which we just discussed. And the data, this is the entire reform period, 79 through 2018. And then the reform period is broken up into 4 phases to show the relative contributions of these different factors to GDP, or to economic growth. So throughout the reform period, we had 7.5% annual change in real output per worker. In 79 through 88, which was the initial 10 years of reform, what I call the Zhaoziang period of reform, that was primarily generated by total factor productivity. You can see how important it was in the first 10 years. And this was really what I call the Communist Party picking the low-hanging fruit. The economy had been managed so poorly up to that point. When I arrived in China in 1979, China accounted for 1/4 of the world's population, yet only 1% of world GDP. This is with 800 million people who are very smart and very capable, producing only 1% of the world's GDP. Clearly, this was a result of structural factors in the economy, and it didn't take a genius to figure out what those impediments were. And the Communist Party, Deng Xiaoping, and others took immediate steps to, in fact, start to restructure the economy. They stopped the communes. They created some free markets. They allowed some private enterprise to start up. They did all sorts of very obvious things, what I call low-hanging fruit, to restructure the economy toward a more flexible economy that would take advantage of China's vast human resources. So this took place over about a 10-year period. You can see they had great success with total factor productivity leading the way. What happened, though, is you had a great increase in household income, which led to high inflation. And because of the decentralization of resources, at the same time, the central government started running out of money, out of revenue. So on the eve of June 4th, the Communist Party was looking at losing both political and fiscal control of the country, it is, and they clamped down. And after an interregnum, a sort of a new model emerged. This was the post-Tiananmen retrenchment, 89 to 98, in which case the government returned to a more urban-based, capital-intensive sort of growth program. Structural change continued, reform continued. You had the company law and all sorts of things. You had the banks being reformed. You had the thinking about stock markets. So structural reform continued, but at the same time, the physical capital per worker started to displace other drivers of growth, and in fact displaced total factor productivity as the main driver of growth through this period. And then you get 1999 to 2008, this period, and you see this really take place in spades. Physical capital per worker becomes the dominant driver of growth. In other words, what we looked at on that chart earlier of the endowments, capital, land, labor, and capital being an input. So you're getting extensive growth through massive application of capital. And this is fine. China was underinvested for a long time. And additions to capital and the capital base were completely appropriate, but not necessarily at the expense of total factor productivity. So during this period, you continue to have reforms, which are reflected in total factor productivity, but also you have an increase in capital investment, which becomes the main driver. And then you have the financial crisis. The financial crisis, by the time of the financial crisis, the Chinese government decides that it's going to stimulate the economy through increased investment, increased capital formation, right? But at this point, China is no longer is no longer underinvested. So the returns on the capital are much lower, and also a lot of debt is being incurred to fund the capital. And but as a result, but at the same time, Xi Jinping decides to sort of stall reforms and not put in the reforms that he had promised when he came to power. So over this period of time and up until the present, you will see that capital per worker still drives growth, but growth, as we saw, was declining overall, but being driven by what growth is driven by capital increases. And total factor productivity is now a minimal part of the picture because of the stalled reform program. All of the low-hanging fruit and the easy reforms have been completed, and so the hard reforms have yet to be done. We'll talk about those in a moment. And capital no longer can be deployed to get high returns because China is no longer undercapitalized. Okay. Now let's talk about GDP and China's GDP, how it's formed. As sort of an illustration of this, GDP, as you might recall from your economics class, is in the consumption cycle is private consumption, including business consumption of final products, plus investment, plus government consumption, plus net exports, okay? And if you're interested in the concept of GDP, which is a fairly new concept, in fact, I recommend this book by Diane Coyle. But if you take the four components of GDP I just mentioned, you look at China, since the reform period, 1979 to 2019, these are the four components. Household consumption is the bottom. This is investment or capital formation. The red is government final consumption of goods and services. And the green are net exports. And you can see what's happened over time. In the first 10 years of reform, or where total factor productivity was the main driver, you actually had household consumption driving economic growth. And of course, this led to some inflation, which was one of the drivers of Tiananmen on June 4th. And then after that, you see what happened. You see over time, up until even now, that personal consumption has been displaced by capital formation as the main driver of GDP. So the question is how normal is this? Is China an outlier? Well, let's look quickly at some other countries. Let's look at China and the USA over the same period of time. And you can see how very different, in the United States, we love our consumption. Consumption now accounts for 65% of GDP in the United States, where it's only recovered about 40% in China. The US is a net importer, so it doesn't have net exports. But is it fair to compare China and the US, two very different countries? Let's compare China and Korea, a country that also depends on exports. And even so, you can see that Korea, still 50% of GDP is accounted for by personal consumption. So a very different picture. Let's still a small country. Let's look at India. A lot of people like to compare China and India. Very similar countries. Here's something very interesting is going on. You see India, as, similarly to China, you have capital formation displacing personal consumption, which makes sense because India, as anybody who goes there knows, is terribly underinvested. So increases in capital formation should be expected. But even so, 60% of India's GDP is accounted for by personal consumption. Brazil, you see the same sort of picture. Russia's interesting. Russia is you see all the net exports, that's mostly raw materials and fuel and that sort of thing. But even so, Russia's GDP is still driven 50% by personal consumption as well. So China is truly an outlier in this regard, both over time and across countries. And so therefore, this has become a real problem for China's growth model because you can only invest so much and borrow so much to do that before your returns go down and you have a massive misallocation of resources. So what's the problem and what's the opportunity? Because the problem is the opportunity. According to the World Bank, even after 4 decades of 10% growth per year, per capita income in China is less than a quarter of the high income country average at market exchange rates and less than a third in purchasing power parity terms. Despite advances in some sectors, China generally remains distant from the global technological frontier. Total factor productivity is less than half that in the United States and lags the TFP levels in a number of middle-income countries. So even while China's economic growth is going down to 6, 5, maybe even 4%, it is still far from the frontier of where it needs to be. What's to be done? Again, according to the World Bank, achieving productivity growth through improved allocation of resources will require deepening reforms to increase the role of the market, the private sector, and competition. All right. So what does that mean specifically? Well, what it means is government spending has to be reallocated from fixed capital investment, building bridges, building real estate, building factory capacity, to services, to building out education opportunities, more schools, to health, making sure people have health insurance. The social security safety net has to be funded. All of these things, because they're underfunded, make people save their money for a rainy day. If the government starts to fund these areas, people will feel more secure about then taking that money and then spending it on other things. The next thing that has to be done is household incomes have to be increased. As we saw, capital formation has displaced consumer personal consumption. as a driver of GDP. Well, if you want people to consume more, they have to have the incomes to do it, and they have to have the security to spend that money as opposed to saving it for health education, and education and Social Security. The private sector has to be invigorated because the private sector is a source of employment and innovation, which is so important in total factor productivity. Private firms need access to financing, debt, and equity. The banks in China still don't know how to do cash flow lending to private companies. This has to change. And also private companies tend to be last in line to do IPOs in China. And the government needs to make state-owned enterprises behave in the value chains of the private firms. SOEs tend to have monopoly pricing powers, which means in various value chains, profits tend to pool at the SOE level. And it's not fair. And so the government needs to make sure that SOEs are behaving in other people's value chains, not taking advantage of their monopoly pricing power to suck profits from other parts of the value chain. There has to be greater discipline in credit markets, which means there have to be hard budget constraints for SOEs and subnational governments, so they cannot continue to borrow money and spend it on projects that have very low returns. And the central government has to step up. The central government goes out of its way to maintain fiscal space, to maintain its balance sheet in a fashion that it can step in at any time to deal with crisis. Well, that fiscal space is there for a reason, and they should use it to make sure that local governments are not overburdened with unfunded mandates. There needs to be improved entry and exit into various sectors. Right now, that's one of the main drags on resource allocation, is that entry into various sectors as well as exit is obstructed by various policies. And then within sectors, reallocation of resources has to be facilitated through better bankruptcy procedures, better M&A procedures, and that sort of thing. All of this is just a brief list of the very specific things that need to be done to invigorate the private sector and make sure the market becomes more important as an allocator of resources in China. Why is this so hard to do? This seems quite simple. It doesn't take a Nobel Prize in economics to figure this out. People have been talking about this for some time. None of this should be a surprise to anybody who pays attention to China's economy. Unfortunately, every action item that I just mentioned either reduces the control of the Communist Party and or adversely affects the interests of important actors in China. And so that is why these decisions are political, not economic decisions. So in conclusion, short of a Nobel Prize, every economist desires to have a curve named after them. You'll see here the Laffer curve, which shows the relationship between tax revenue and tax rate, with an ideal tax rate to achieve the most revenue. The Laffer curve was conceptual. It wasn't empirical. He was simply setting out a concept, right? And so with that in mind, I leave you with the Hawke curve. Now the Hawke curve is half empirical and half conceptual. The x-axis is empirical. This shows simply China's economic performance as a percentage of US per capita GDP, much like the previous chart we saw. And the y-axis is more conceptual. This is the Chinese Communist Party's social and economic control of the country. And we saw that from 0% virtually, when I arrived in China in 1979, to 25% of US per capita GDP, where China is roughly today on a person power parity basis, the Communist Party has had to give up very little social and economic control. This is what I call the low-hanging fruit picking part of China's development. China was able to achieve rapid rates of growth without sacrificing, basic planning and state control. Those days are over. The low-hanging fruit are gone. And in order to continue to grow at a rapid pace and achieve greater economic performance as a percent of US per capita GDP, the Communist Party is going to have to give up some control through good governance and innovation. And by good governance, I mean allowing markets to make more decisions and allowing the private sector to have more power and to make more decisions. So this generates what I very immodestly call the Hawke curve. So short of a Nobel Prize, at least I have named a curve after myself. So anyway, that's the short take for now on China's economy. I hope you enjoyed it, and I can be contacted if you have any questions. Thank you very much.